So learning objective 2 and learning objective 3 are all about what we call adjusting entries. Now, the adjustment process is in place so we can sort of double check the accounts to see if all the revenue has been accounted for that period and all the expenses have been accounted for in that period. So we can be very, very certain that our income statement is accurate. Remember, the information from the income statement, which is a profit or loss, flows into the retained earnings statement. And then that flows yet again into the balance sheet. So it's really important that when we prepare our statements, we're pretty darn sure about those numbers. The adjustment process that we're looking at pretty much helps us see that, yeah, these numbers are pretty damn good. Okay. So the first adjusting entries that you're going to be introduced to are what we call the deferrals. So to defer is really just to postpone or to delay. And so these deferrals basically are, we have to wait before we say we earn the revenue. We have to wait before we can actually create the expense. And so when you look at this, deferrals are either basically what we call prepaid expenses, and a prepaid expenses start as an asset, but after we use them, will be an expense. And I apologize for my really bad finger writing today. Actually, almost every day. I have to just um, apologize for today. It's terrible every day. So it starts as an expense, but after we use it, it starts as an asset. My God. It starts as an asset, but after we use it, it turns into an expense. So when you look at, for example, supplies begins as an asset, but after we use the supplies, we have a supplies expense. So prepaid expenses are simply assets that are used that turn into expenses. But of course, we have to use them first. So we have to wait to use them before they can be expensed. That's the deferred piece. Unearned revenue, you probably know this account is a liability account. Unearned revenue is when the customer gives us money up front and we have to wait, right? We have to wait to earn it. We owe the customer whatever is they paid for. So it starts as a liability, but once we give the customer what they paid us for, then it becomes our revenue, right? But of course, that takes time. In other words, we have to wait, the deferral piece. It starts as liability, we wait, we deliver things to the customer, and now we can say it's our revenue. And that's important because these accounts start on the balance sheet, right? And that's no BS, but they end up on the income statement. And the income statement is the very, very first statement we have to do here when we prepare financial statements. So that's important to know. So there are 4 deferrals that you're going to be learning in this part of the chapter. 3 of them are in the category of a prepaid expense. Prepaid expenses start as assets. Once we use the assets or we consume the asset, we expense it. Now, you've already heard of several asset accounts that are listed down here. You know about prepaid insurance. You also know about supplies. Okay. You haven't heard of prepaid advertising, but prepaid advertising is a current asset account, just like prepaid insurance is, just like supplies. They're current asset accounts. There's also an account called prepaid rent, which also, like prepaid insurance and prepaid advertising, is a current asset. Okay. So the first 4 that are listed here are all current assets. We plan to use these very quickly, right, within the year. And so after we use them, we can expense them. That means that when we use prepaid insurance, we will have an insurance expense for the part that we used. Once we use our supplies, we will have a supplies expense. Right? If we had prepaid advertising, once we've actually used the advertising, we would have an advertising expense. If we had prepaid rent, which starts as an asset, after we have used it, it becomes a rent expense. Now, we also have property, plant, and equipment accounts, building and equipment. These are long-term assets, right? We're going to be using buildings and equipment for many, many, many years. So they're not going to be used quickly. They are going to be used over the very long term. And so what we do to expense the portion of that we've used is we go through a process called depreciation. And depreciation is a way in which we allocate the cost of the equipment and buildings over time. We allocate it as something called depreciation expense. So again, these are all assets, but once we have used them or we've consumed them, they become expenses. So pay attention, here we go. In order to fix this, we have to do an entry in our journal, in which case we debit the expense and then we credit the asset. That's what you're going to be seeing here, okay? So again, everything for the prepaid expenses require a debit to the asset account, a debit to the expense account, and a credit to the asset account. It's always going to be the same. So let's start with supplies. You remember Sierra Corporation had $2,500 of supplies that they started October with. Okay. It's at the end of October, so the period of time here is 1 month. At the end of the month of October, they only have $1,000 of supplies on hand. So the word on hand simply means they still have them. So what happens is that this company started with $2,500 worth of supplies at the beginning of October. At the end of October, they had $1,000 of supplies. The difference they've used. If they've used them, they can expense them. So what happens is it requires a journal entry. Remember what we did in chapter 3? We put entries into the journal. Same thing here in chapter 4. I told you it was going to repeat itself. But the entry here specifically on October 31st is a debit to supplies expense and a credit to supplies. That's for the amount that has been consumed. We've used up that much, so we can expense that much. What happens after we put everything in the journal? Well, it goes to their accounts in the ledger. And so once we post this entry into their appropriate ledger accounts, you'll see the balance in supplies is now $1,000, which is what we have right here. So that matches up quite nicely now. This record is accurate. And of course, you see this expense for supplies expense now has a balance. So this is the first prepaid expense you're going to have to learn about, is how to deal with supplies. It's where they started with minus what they ended with. That's what they've used. That's what they can expense. At the end of a period, this period is a 1-month period. Sometimes it's monthly. Other times they'll say it's for the year. But just know what period of time you're expensing, and you're fine. All right, insurance, as you know, Sierra Corporation bought $600 insurance policy. It's a full 12-month insurance policy, and it began October the 1st. Well, we are now October 31st, and they have used up, right? This is a full 12-month policy. They have used up 1 month of the 12 months. So how much is 1 month? Well, you take the $600 policy and divide it by 12. That's $50 for every month. So they have used up $50 of the insurance after that first month. Okay, it's a 12-month policy. After October, now we're down to an 11-month policy because we used up 1. So now we can actually expense that $50, and we do so quite easily. We debit the insurance expense by $50 on the debit side. We credit prepaid insurance by $50 as well, right? Prepaid insurance, again, is an asset. Asset is lower because we've used some of that asset, and that's why we expensed it. That, of course, is the journal entry. And you know what happens after anything that goes into the journal posts to the ledger. And so what you see in the ledger account for prepaid insurance is now the balance has been adjusted. This asset is now worth $550 because we've used up 50 of it. And that's how we got the expense of $50 for insurance. Yeah. Okay. This is the second prepaid expense you have to learn about, and it's relatively straightforward. Okay. The third one is on depreciation. And as I mentioned to you, when you buy equipment or a building or a motor vehicle, so like a delivery truck, they are assets. Okay. They're not an expense. When you buy them, they're your asset. You're going to buy them and you're going to use them for a very long time. You cannot expense something until you've used it. Okay. Which is why when you buy a vehicle, you can't expense it the day you buy it because, well, you're going to use it for the business for a long time. So that changes the episode. It was different if you're just going to use it that day and throw it away. Okay, then you probably can expense it that day, but that doesn't make any sense. No one's going to do that. They're going to have this for a very long time. So it's an asset. As we use it, clearly we're only going to use it for so long a period of time. We call it a useful life. So let's say UPS buys a truck. Well, those trucks are going, not necessarily 24/7, but it's very close. I mean, they're always on the go. How long is that truck going to last? That new delivery truck going to last? Well, they may decide that its useful life is going to be about 3 years, 4 years before they're going to need to replace it. It's not going to be efficient to use and it might break down, and that's not what UPS is about. UPS is about delivering packages on time quickly, right? So the new assets will allow that to happen. So they're not going to use it forever. Its useful life is only a few years. And so then, okay, as they use it, they start allocating a part of the cost of that asset to what we call a depreciation expense. Okay, to show that, hey, this asset helped me generate revenue. That's because without the truck, I can't deliver the package. And the reason I make revenue is delivering packages. So the truck is directly related to my revenue and thus directly related to the fact that I can match the expense with the revenue. So depreciation expense comes across in that way. All right. We don't try to report a change in value in an asset. We simply allocate the cost of the asset through its useful life. And you'll get a lot more on depreciation in chapter 9. But anyway, in terms of a prepaid expense and how it works here, depreciation is going to be given to you. There's no calculation to do in this case. They actually just give you what the depreciation is. So Sierra Corporation, they have a bunch of office equipment and it depreciates at $480 a year, but we're only looking at October. So it's $40 for the month. So what we do is we expense it for the month of October with the depreciation expense. The difference is the credit doesn't go to the equipment account. It goes to an account called accumulated depreciation for equipment. Now, you might have seen this account on the classified balance sheets that you had that you did from chapter 2, where you saw equipment less accumulated depreciation on the equipment, and it got a book value. This account technically is an asset account, but it's an asset account with a credit balance. It's called a contra asset. All these fun little things you're learning. But this is basically what we would do at the end of every period. We would debit the depreciation expense, credit the accumulated depreciation for the equipment or whatnot. Notice the equipment account isn't affected. Instead, we attach this sort of this piggyback account, accumulated depreciation on equipment, next to it, showing how much of the equipment we have actually expensed through depreciation. All this tells us is how much depreciation we have already expensed over the time period that we've owned the equipment. Okay, and so far it's only $40, but this will grow over time clearly. So this is what you've probably heard about this before, but this is what we call the book value of the equipment. The book value is simply the amount that we spent on the equipment minus out any accumulated depreciation. This is a book value. Accumulated depreciation, as it says in the book, is an asset account, but it's something called a contra asset account because it has a credit balance instead of a normal debit balance. That's what the contra means. It's opposite balance, basically. And there are lots of different contra accounts. This is just the first one you've heard about. Well, what if we didn't do the adjustment? What if we didn't do the adjustment? Well, one of the biggest problems in not doing the adjustment, these three adjustments, is our expenses would be lower than they really are. And what does that mean? Well, if your expenses are lower than they really are, your profit looks bigger than it really is. And the owners are going to think they hit the jackpot when they didn't. And so being sure we go through this adjusting process for these prepaid expenses is really important to make sure that those expenses are there and the income statement's more accurate. Furthermore, all of those asset accounts would look more valuable than they really are. Looks like you'd have a lot more supplies than you really do, a lot more prepaid insurance that you really do, and the book value of your equipment would be higher than it really is. So your assets would look much bigger than they really are in value. So this is the problem with not doing an adjustment. The adjustment is very, very important, okay, that we make sure we have that done. All right, the unearned revenue is, again, it starts as a liability. Unearned revenue means we receive the cash by the customer. We owe the customer what they paid for, right? And unearned revenue is actually quite a common account in a lot of businesses. All right. For example, if you've ever gone on a trip and you bought an airline ticket, you're usually buying it well ahead of time. So when you buy the ticket from the airline, they can't say that's revenue yet. They haven't earned it. Remember, revenue is earned. Okay, earned means you've earned it. You've already done the work. Unearned means you still need to do the work. Right? And so when you purchase an airline ticket, they put that down as unearned ticket revenue, the liability account, until you get on the plane. And as I always just say, it only has to take off for them to say it's theirs. And so then it's their revenue, right? As soon as that plane takes off, they don't owe you the flight anymore. You're on it. Now it's their revenue. Well, that means it has to shift from a liability into a revenue account. And that's what's going on here. Same thing with any deposit a customer makes. You might have purchased tickets to a sporting event or a concert. You might have put money down on a cruise or a Disney vacation. Those deposits are unearned revenue for those businesses. They owe you what you paid for, whether it's a baseball game or a concert of one of your favorite artists, or nights at a hotel, or tickets to Disney, what have you. They owe you that. So it's a liability. But when you actually show up for the concert, when the concert's ready to go, then it becomes their revenue. And that's the adjustment we're doing here. Okay. So what we need to do is basically lower the liability account and credit the revenue account when it's time. Right? So we're going to lower the liability account with a debit, increase the revenue account with a credit. That's how we adjust for unearned revenue. And this is how it works. So remember, Sierra Corporation got $1,200 from their client Arnox for these future tours, right? Because that's what they do, guided tours. Well, they did an evaluation at the end of October, and they actually performed $400 of tours for Arnox in October. Okay, well, then that needs a adjusting entry. That $400 is still sitting here in unearned revenue, where it should be in revenue. So we debit the revenue account unearned service revenue account by 400, and we credit the service revenue by 400. That's the journal entry. It'll get posted into the ledger. Now the liability is lower, $800 in unearned service revenue, and our service revenue is higher. Remember, revenue is where the profits are. So that's all good. That's all good stuff. Okay. If we didn't do this, our revenue account would be lower. Remember, revenue is where the profits are. Net income is literally excess revenue. You have revenue minus expenses is your net income. You could also call it excess revenue, right? Your revenue is bigger. It's your profit. Okay, it's excess revenue. Revenue is where it's at. That's where it comes from. So you never want that to be understated, because if your revenue is understated, so is your profit. All right. And then, of course, if you don't recognize that, it still looks like you owe all that stuff. It's still going to be an unearned revenue. It's still going to be a liability on the balance sheet. It's look like you have more debt than you do. So not doing the adjustment is a bad idea. Okay. And so that's learning objective 2. 4 different entries you have to learn, and they're wrapped up in this exercise here. So here's a whole bunch of accounts for Hammond Company Incorporated at the end of March. Prepaid equipment, supplies, their equipment and accumulated depreciation accounts are here together, and unearned service revenue. And here's the analysis they have. Looks like they used up insurance. They have $100 of insurance that they used for the month of March. At the end of March, they only had $800 of supplies. Equipment depreciated at $200 for the month of March. And at the end of March, they actually earned $4,000 of the unearned revenue. And we're going to be preparing the entries. So the very first thing is they tell you insurance is expired. So that means that prepaid insurance is not correct. It has to be adjusted. How do we adjust it? With an insurance expense and a credit to prepaid insurance. Now it's correct. The second thing, supplies were $800. Well, they started with $2,800. They ended with $800. They've used the rest. That's what we can expense. Supplies expense with a debit of $2,000, supplies with a credit of $2,000. And that now is correct. Equipment depreciated at $200 a month. Okay. We have accumulated depreciation that's going to be affected here. The depreciation expense gets debited by $200. Accumulated depreciation for, and it should be dash equipment here, it should be this particular formal name, gets the credit for $200. Okay. And the very last thing is, look, we owed people $9,200 of work. We performed 4,000 of that. So that liability is now needs to be adjusted. How do we adjust it? Well, we lower the liability account with a debit, and we move that 4,000 into revenue because now we earned it. And that is how that would work. Questions on objective 2? Is that step by step enough? Okay. All right, I got one thumb. Thank you very much. I appreciate the thumbs. Love thumbs. Love thumbs. All right, we got 3 more adjustments to do. Okay. Learning objective 3 indicates that we have 3 more to do. There's a total of 7. There's not that many to learn, and they're all outlined in the book, which is wonderful. So you're going to be having, you're going to be doing lots of adjustments this weekend. Certainly in accounting, hopefully maybe an attitude too, I don't know, but you'll definitely be doing adjustments for sure. All right, so let's keep going here. Learning objective 3 is next, and that is doing these same adjusting entries, but for the categories that we call an accrual. And accruals basically are revenues that you've already earned, but you haven't billed the customer for, so you've got to put them in the books. And expenses that you've already incurred in a particular month, but you didn't pay for them yet. So we have to record those as well. Again, everything is going to be revolving around revenue and expenses because the very first statement we do is the income statement. which is your revenue and expenses. All right. So we have to make sure these are right. Accrued revenues are going to be the easiest ones to do because basically you did the work, but you haven't recorded it yet. Okay. So it's really, really easy. Basically, you want to record the revenue and set up a receivable because you need to go collect it. Right. So you show you needed to show up a receivable, and of course you put the service revenue in. And that's really all an accrued revenue is. So again, we're going to be debiting the receivable, crediting the revenue. That's it. Okay. So here's an example. Sierra Corporation actually did work on October 31st for $200 worth of tours, but they had not billed the client yet. Duh. So again, if the work happened on the 31st or in October, it's going to be recorded in October, right? Revenue recognition principle. Very important, right? We record things when they happened, So in this case, we earned it, but we didn't bill the client. So that's easy to fix. We'll send them a bill, which is an accounts receivable for us. And we show the $200 was revenue for the month of October. That's really important. Again, that revenue is going to show up in October. Once we post that into their ledger accounts, now we have a balance in accounts receivable at the end of the month of October. And our service revenue, look, is adjusted now upward to $10,600 because that new adjustment. Again, we've done 2 adjusting entries in this that have boosted our revenue by 600, which means our profit's going to be larger as well. Okay. Very important to include all of this. If we didn't do the accrued revenue, that's a problem because if that revenue is missing, so is the profit. And then, of course, we wouldn't have shown that we had a receivable, and so our assets would also be understated. For accrued expenses, basically, it's we have incurred an expense in this period of time, but we haven't paid it yet, basically. And this actually happens, not frequently, but enough where you have to do adjustments. And the book really looks at 2 particular accrued expenses that are really important to understand, okay? One is something called accrued interest. And accrued interest on any loans that a corporation has is considered a cost of doing business, and they can expense the interest. They can't expense the loan. They can expense the interest on the loan. And so we're going to look at accrued interest. And then, of course, you and I get paid on a regular schedule. Maybe it's weekly, maybe it's every other week, but you have to work first. You put your time card in, and then you wait. You might wait a week, you might wait 2 weeks to get paid. Well, what happens if some of that happened in 1 month and you get paid in another month? Well, that would be an accrued expense, and you're going to see how that works as well. All right, so we basically are recording that we owe the money because we haven't paid it yet, but we need to recognize the expense in this period, so it'll be on our income statement. So debiting the expense, crediting the payable account that you'll be learning about. There's 2 of them you'll learn about here. All right, first things first, interest, accrued interest. So like I said, businesses have loans. They take loans, no problem. On any loan, as you know, there's interest that's charged on the loan. For this particular company, they had a 3-month note payable. So what happens in a note payable is you pay back the loan and the interest on the loan when it's due. You don't make any payments prior to that. You may pay it all on the day it's due. So they took out this loan on October the 1st. They don't have to pay it back until 3 months with interest, which means it's not going to be paid until January the 1st, because that's 3 months away from October the 1st. So every month that they have this loan, interest is accruing on the loan. So for the month of October, how much interest has accrued on this note payable? Well, that's this formula right here. It's the $5,000 loan, the note, times 12%. 12% is the annual rate, meaning it's for all 12 months. All we care about is 1 month of the 12. So we multiply that by the time, 1 month over 12. And we see that $50 of interest has accrued on this note. Because it happened in October, it can be expensed in October. Of course, we're not paying any of this until we pay the whole loan back on January the 1st. But that doesn't mean that this loan, this note, didn't cost us money in October, because interest was accruing. In October, it will in November, and it will in December. So literally every month we'll have an interest expense for this one loan, $50. Okay. So how we record it simply is, in our journal, we're going to put a debit to the interest expense for $50. But of course, we're not paying this interest until January the 1st. So we're going to set up something called an interest payable to show we're going to pay it later. Okay. When that's actually posted in the ledger, if I can finish my little arrow there, I will show you that now we have an interest expense for $50, and now we have an interest payable for $50. Okay. So again, on any loan a business has, the interest on the loan can be expensed. Okay. So it's very interesting. Ha ha ha. All right, accrued salaries. This happens to everybody. This should be relatively simple to understand. The interest is always one that people sit and think about it for a while, but salaries is pretty easy to understand. So here's Sierra Corporation. In the month of October, as you see here, their very last pay period, the very last payday was Friday, the 26th of October. Okay. Their next payday isn't until Friday, November the 9th. Well, the issue is that they're only a 5-day business, so they only work Monday to Friday. The Monday, Tuesday, and Wednesday, October 29, 30, and 31, is work done in October that won't be paid until November. So these 3 work days should be expensed in October because they happened in October. Okay. So if you pay people, if you pay your payroll is $2,000 for a 5-day work week, that means every day is $400 in payroll. And you have these 3 days in October that that people were working. So you have a total of $1,200 of payroll that needs to be expensed in October, even though you're not going to pay it until November. And that's basically what accrued salaries are. Again, the work days in October is when the expense actually happened. That's when we record it. So how do we record it? Well, at the end of October, we are simply going to do a very simple entry. Salaries and wages expense for $1,200, showing that expense happened in October. Setting up a salaries and wages payable for $1,200. Remember, payable is a liability. We're going to pay them the next payday, no problem. Then, of course, that gets posted in the ledger. And here, salaries and wages expenses now have been adjusted in October. Now, total salaries and wages expense in October is $5,200. And of course, salaries and wages payable has a balance as well. So what happens if we did not do these adjustments? Well, the most important thing, again, because we're starting with the income statement, is our expenses would look smaller. That's understated. They would look smaller. If the expenses are smaller than they really are, the profit is bigger than it really is, and that misleads the owners. They don't like that. And in terms of this, and I love how they misspelled liabilities as liabilities. Maybe if you have a dog, that might be really funny. But the liabilities of the company would also be understated because they would not be able to set up those payables. And remember, payables are liabilities. So that would be an issue. Okay. So to look at learning objective 3, the adjusting entries we just went over are for accruals, right? Here we have, and there's 3 of them, only 3 to know. Here we have a company, Microcomputer Services. They began operations in August. And at the end of August, they want to make these adjusting entries. For what? Well, the first thing is they owe their employees $800 in pay. The second thing, as you see here, is they took out a loan. We don't care how long the loan is for. All we care about is what amount of interest is expensed in the month that we're talking about. Okay. And the third thing is revenue was performed, but we never recorded it. So now we have to set up a receivable. So prepare the adjusting entries. First thing is, since we owe our employees $800 because they worked in August, we will simply go ahead and expense that $800 for August and set up a payable. Again, the only thing that's missing here in the journal would be the date, would be August 31st. Okay, because it's happening at the end of August, so it would have that particular date. The next thing is always the most interesting one because, again, this is where people slow down a little bit. We're only interested for what interest can we expense for this month. That's it. So to do that, we take the amount, $30,000 is the loan, multiply it by 10%, which is the annual rate, but we're only interested in 1 month. So we multiply that by 1/12. And when you do that, you will get an interest expense for August. I don't like that they don't have the dates here. An interest expense of $250 for August. We're not paying it until later, so we set up an interest payable of $250. So again, that's the $30,000 times 10% times 1/12, or 1 divided by 12. And that's how we got the 250. And the last thing is the easiest one, right? We did work, but we didn't record it. So we have to put this on the books. Debit accounts receivable for $1,100, credit service revenue for $1,100. That way everything has been recorded and our books are as accurate as they can be. So how did that go? Any questions?